Welcome to Market Brief After Hours. It has been a wild ride of a week on Wall Street, with tech stocks taking a heavy beating, geopolitical tensions flaring up in the Middle East, and some fascinating shifts in the currency and commodity markets. Let's start with the big picture. Wall Street wrapped up Friday with some pretty steep losses. Just how bad did the major indexes get hit?
It was definitely a tough week for equity investors. Friday's session really cemented a weekly decline across the board. The S&P 500 fell 1.01% on Friday to close at 7,458, which brought its weekly loss to 1.6%. The tech-heavy Nasdaq composite took an even harder hit, dropping 1.4% to end the day at 25,520, ending the week down a hefty 2.9%. Even the blue-chip Dow Jones Industrial Average couldn't escape the selling pressure. It shed about 407 points, or 0.77%, closing at 52,146, which translates to a 0.9% loss for the week.
That's a significant pullback, especially for the Nasdaq. It feels like the tech sector, which has been the darling of this bull market, is suddenly facing a lot of skepticism. What is driving this sudden shift in sentiment?
A lot of it comes down to semiconductor stocks and growing questions around artificial intelligence valuations. The VanEck Semiconductor ETF, which tracks the major chip makers, posted its third weekly decline in 4 weeks, dropping almost 9% over that period. What really triggered the sell-off on Friday was news from China. A startup called Moonshot AI unveiled a new open-source model that reportedly narrows the performance gap with top U.S. offerings from companies like OpenAI and Anthropic.
That is fascinating. So a breakthrough in China is actually causing U.S. chip stocks to slide? How does that connection work?
It raises fresh concerns about the massive pace of technology spending. Investors are starting to ask whether the aggressive capital expenditure we've seen from major tech companies is going to yield the expected returns, especially if open-source models can deliver similar performance at a lower cost. There are definitely signs of fatigue. End-user demand for AI is becoming more price-sensitive, and the market is beginning to penalize companies that are ramping up their spending too aggressively. It looks like the AI theme is maturing rather than breaking, which is actually a very normal, healthy part of how major technology investment cycles evolve.
Speaking of tech giants, we also saw a major shakeup at the very top of the valuation ladder, didn't we?
We did. Apple actually surpassed Nvidia to reclaim the title of the world's most valuable company. In early hours trading, Apple's valuation reached $4.92 trillion, compared to Nvidia's $4.86 trillion. It's a stark reminder of how quickly the tide can turn when the market starts to reevaluate these high-flying AI valuations.
Absolutely. Now, this risk-off sentiment wasn't just limited to the U.S. We saw a domino effect across global markets. Let's look at Europe first. How did those markets fare?
European markets closed mostly lower on Friday. Geopolitical worries in the Middle East pushed oil prices higher, which immediately raised fears about inflation and the path of interest rates. The Pan-European Stoxx 600 index fell 0.34%. Looking at individual countries, Germany's DAX dropped 0.34%, and France's CAC 40 fell 0.47%. On the flip side, the UK's FTSE 100 managed to buck the trend, closing up 0.27%, while Switzerland's SMI climbed 0.54%.
And what is the inflation picture looking like in Europe right now? Is there any relief in sight?
Interestingly, Eurozone annual inflation was confirmed at 2.8% for June. That is down from 3.2% in May, making it the lowest level since February. That drop happened just before the latest disruptions in the Middle East started pushing energy prices back up. So while inflation is easing, and core inflation, which strips out energy and food, fell to 2.4%, it still remains above the European Central Bank's 2% target. We also saw some mixed economic data. For instance, the Eurozone current account surplus rose to 25 billion euros in May, but Italy's current account surplus actually shrank quite a bit to just under 594 million euros, down from 1.9 billion a year earlier.
Now, if Europe was weak, Asia seemed to experience a flat-out rout, particularly in the tech space. Walk us through those numbers.
Asia was hit incredibly hard. In Japan, investors aggressively dumped chipmakers and other AI-related stocks. The Nikkei average plummeted by 4.03%, while the broader Topics index fell 2.72%. In fact, the Japanese stock market has now entered a technical correction, having fallen more than 10% from its all-time high in June. To give you an idea of the damage, Kioxia holdings plunged over 16%, while major players like Advantest, Tokyo Electron, and SoftBank lost between 7% and 9%.
That is a massive drop for those Japanese tech giants. What about China and the rest of the region?
China's Shanghai Composite tumbled 3.05%. That was driven partly by liquidity fears surrounding a massive $8.6 billion IPO by CXMT, alongside a busy pipeline of other large listings. Meanwhile, Hong Kong's Hang Seng Index fell 1.78% following that overnight sell-off in U.S. tech. Down under, Australia's S&P ASX 200 dropped 0.5%, dragged down by lower commodity prices affecting the mining sector, though New Zealand's benchmark managed to snap a 4-day losing streak, rising about 0.6%. South Korea was closed for a holiday.
Let's take a quick break. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were talking about the global stock market sell-off. But another massive story driving the markets right now is the escalating conflict in the Middle East and its immediate impact on energy markets. Can you fill us in on what happened on Friday?
This is a highly volatile situation. Oil prices surged after Kuwait reported that Iran had attacked a power and water desalination plant in the Persian Gulf. This is a critical piece of civilian infrastructure, and the attack caused significant damage and fires. In response, the U.S. Central Command announced it completed its 6th consecutive night of strikes against military targets in Iran. In retaliation, Iranian officials claim to have targeted U.S. forces across several countries, including Syria and Bahrain.
And how did the energy markets react to this escalation?
Crude prices jumped. U.S. West Texas Intermediate crude futures rose 4.5% to settle at $82.49 per barrel. And Brent crude, the international benchmark, advanced 4.6% to close at $88.10. Now, some analysts are pointing out that even with this spike, oil prices are still within their historical average range. But the fear of further escalation is definitely keeping investors on edge. Interestingly, Iraq and Syria just signed an agreement to rebuild an old oil pipeline from Kirkuk to the Mediterranean coast. It has a capacity of 700,000 barrels per day and has been closed since 2003. But if rebuilt, it could provide a vital alternative route that bypasses the Strait of Hormuz entirely.
That would be a major structural shift for global oil logistics. Now, let's pivot to the U.S. economy. We had a bunch of economic data releases on Friday. How is the domestic outlook shaping up amidst all this global chaos?
It's a mixed bag, but it shows the U.S. economy is still proving resilient. On the housing front, building permits fell more than expected, dropping 3% in June to a seasonally adjusted annual rate of 1.37 million, which points to some cooling in construction. On the inflation side, import prices unexpectedly rose by 0.3% in June. While that's a slowdown from May, economists were actually expecting a 0.7% decline. However, industrial production edged up 0.1% in June, and consumer sentiment for July actually improved to 54.4, up from 49.5 in June, largely because gasoline prices cooled down during the survey period.
And how did the bond market react to all of this?
Treasury yields were mixed. The yield on the key 10-year Treasury note, which is the benchmark for consumer debt like mortgages, dropped about 2 basis points to 4.545%. The 30-year yield also fell to 5.067% as government bonds rallied on safe haven demand. Meanwhile, short-term yields like the 2-year Treasury, which is highly sensitive to Federal Reserve rate decisions, rose slightly to 4.179%.
Let's talk about currencies and commodities. There are some really interesting technical setups happening right now. Let's start with the euro and the pound.
The Euro-USD pair is consolidating near its recent lows, closing Friday at 1.1440. If you look at the moving averages, the euro is trading well below its 50-day simple moving average of 1.1530, its 100-day SMA of 1.1585, and its 200-day SMA of 1.1640. This keeps the broader trend firmly bearish. On the other hand, the GBP-USD pair is showing a lot of strength. Even though it pulled back slightly on Friday to close at 1.3458, it is trading above a cluster of key moving averages, including the 50-day SMA at 1.3381 and the 100-day at 1.3400. That base-building phase in late June has shifted the short-term bias to the upside. Now, moving to commodities, gold made a bit of a comeback, reclaiming a key psychological level. What are the charts telling us there? Gold rebounded to close at $4,016, up nearly 1% on the day. That intraday buying was strong, but we have to put it in context. Gold is still trading significantly below its major moving averages. The 50-day is way up at $4,315, and the 200-day is at $4,478. So while this is a nice relief rally, the broader medium-term trend is still downward after that steep sell-off from the $4,800 level. Silver saw a similar story, rising 1.15% to close at $56.15, but it also remains far below its 50-day SMA of $68.62. And we also saw a massive drop in a commodity that many of us enjoy for breakfast, orange juice. What is going on there?
Orange juice prices plummeted to 132.10 US cents per pound, which is a 4.5-year low. It has lost over 17% in just the last 4 weeks and is down a staggering 58.5% over the past year. What's interesting is that the US just confirmed a new 25% tariff on a range of Brazilian imports, but orange juice was specifically exempted because the US doesn't produce enough of it domestically to meet demand. Even with that tariff exemption, the price is just collapsing.
To wrap things up, let's look at some of the individual stock stories that caught your eye on Friday. Who were the big market movers?
We had some dramatic moves. Intuitive Surgical led the losers in both the S&P 500 and the Nasdaq, closing down more than 14%. Interestingly, they actually reported better than expected second quarter earnings, but because they only maintained their full-year forecast instead of raising it, investors aggressively sold the stock. We also saw Star Surgical fall over 9% after its preliminary sales came in just below consensus.
And Netflix had a rough day as well, right?
Yes, Netflix dropped more than 7%. Their full-year revenue forecast had a midpoint that fell just below Wall Street's expectations. This drop actually pushed Netflix below its 200-day moving average by the largest margin we've seen in 4 years. Another big brand, Coca-Cola, fell over 3% after it had to temporarily suspend production of its Fairlife Milk in the US because an unauthorized third party breached some of its IT systems.
It wasn't all bad news, though. There was at least one massive winner on Friday.
Absolutely. Travelers, the insurance giant, popped almost 9% after posting a massive beat on its second quarter earnings.
That's all for today's episode. If you find this useful, please follow Market Brief After Hours for more deep dives into the global markets. Have a great weekend, and we'll see you next time.